On
In the
Wall
United
Street,
States, a
money
high-profile
buys
financier
research,
has been
talent,
found
access,
guilty of
speed, and
insider
influence.
trading.
But
The
there
New
is
York
one thing it is never supposed to buy: inside information. That is what makes the story of Raj Rajaratnam so gripping. He was not a fringe scammer hiding in the shadows. He was the founder of Galleon Group, one of the most powerful hedge funds of its time, a man moving through elite financial and corporate circles with the kind of confidence that only massive success can produce. And yet, behind the polished image of market
The New York
intelligence
court
and
found
investment
Raj
discipline,
Rajaratnam had made
prosecutors
tens of millions
said
of dollars
there was
through
something much
conspiracy
more
and
dangerous at
securities fraud.
work:
The
a
billionaire
secret
hedge fund
economy
trader will
built
appeal
on
against the
stolen
decision.
information. Rajaratnam's rise made him look like the perfect symbol of modern Wall Street success. He was rich, connected, and respected enough to be taken seriously by executives, analysts, and insiders across the business world. Galleon was known for aggressive research and deep market knowledge. On the surface, it looked like the kind of operation that simply did the homework better than everyone else. But the case that eventually destroyed him told a different story. Federal authorities said Rajaratnam was not merely trading on brilliant market insight. They said he was at the center of one of the largest insider trading schemes in American history, profiting from confidential corporate information passed through an underground network of insiders, consultants, and trusted contacts. When the dust settled, the U.S. government said the illegal trading involved companies such as Goldman Sachs, Clearwire, Akamai, AMD, Intel, Polycom, and People Support, among others. And the most striking part of the scandal was not just the money, it was the method. Because this was one of the cases that changed how white-collar crime looked in the public imagination. The government did not only build spreadsheets and gather documents, it listened. Rajaratnam's investigation became famous for the use of wiretaps, a law enforcement tactic more often associated with organized crime, narcotics investigations, and street conspiracies than billionaires in Manhattan offices. Public summaries of the case note that investigators collected 18,150 wiretapped communications involving 550 people over 16 months from 10 telephones, including home, office, and mobile lines. That detail alone changes the feel of the whole story. This is no longer just a hedge fund scandal. It becomes a surveillance thriller. It becomes a story where whispered tips, rushed calls, and confidential earnings information travel through the air as evidence. It becomes the moment Wall Street stops looking like a world of respectable suits and starts sounding like a marketplace where secrets are bought and sold before ordinary investors even know they exist. Then came the courtroom outcome that turned the scandal into financial history. In May 2011, Rajaratnam was convicted on 14 counts of conspiracy and securities fraud. In October 2011, he was sentenced to 11 years in prison, which the U.S. Attorney's Office described as the longest prison term in history for insider trading at that time. He was also ordered to pay a $10 million fine and forfeit $53.8 million. Those numbers matter, but the real impact is cultural. Because Raj Rajaratnam's fall sent a message far beyond his own office. Wealth, privilege, and access would not automatically protect someone from the consequences of using confidential information as a weapon. And that is where this story truly begins. Because before the tapes, before the verdict, before the 11-year sentence, there was a machine called Galleon, and the public still believed it ran on brilliance. Every powerful financial empire tells the same story about itself: discipline, intelligence, hard work, and an edge earned through superior analysis. Galleon told that story too. To outsiders, it looked like a research-driven hedge fund operation that was simply faster and sharper than the market. Rajaratnam cultivated the image of a man who understood sectors deeply, moved quickly, and knew how to extract value from information before others fully understood it. In a world like Wall Street, that image is incredibly powerful, because the line between great investor and information predator can appear very thin until someone shines a flashlight on the details. And that is exactly what happened. The government's case suggested that Galleon's edge did not come only from legal research and instinct. It came, prosecutors said, from a system of access, one in which confidential corporate information traveled through private relationships and reached Rajaratnam before it reached the public. The conviction covered illegal stock trades tied to major companies including Goldman Sachs, Intel, AMD, Clearwire, Akamai, Polycom, and People Support. That corporate list is important because it tells you something about the scale of the network. This was not one lucky tip or one rogue conversation. This was a structure broad enough to touch multiple sectors and important enough to move serious money. And the central force that held the system together was not spreadsheets. It was access. Wall Street runs on access. Access to executives. Access to analysts. Access to consultants. Access to whispers before the press release, before the earnings call, before the public filing changes the price forever. Most of the time, that access operates inside legal and ethical boundaries. But what made the Rajaratnam case explosive was the government's argument that those boundaries had been crossed repeatedly and deliberately. This matters for storytelling because it helps explain why so many people around Rajaratnam seem to drift into the same orbit. In high finance, information is status. If someone has a reputation for knowing what is about to happen, everyone wants to stay close. Some people stay close because they admire the power, some because they want to benefit from it, some because they stop seeing the boundary between legitimate market insight and illegal advantage. That is how a scandal like this grows, not all at once, but relationship by relationship, call by call, whisper by whisper. Rajaratnam was eventually convicted on all 14 counts, and the government emphasized that the case involved extensive illegal trading profits. At sentencing, prosecutors described his conduct as a major assault on market fairness, and the court imposed not only prison time but financial penalties meant to strip away the gains. But before the punishment, there was a deeper question hanging in the air. How did the government prove what was said in private? And that question points to the most cinematic twist in the entire story. This was not only a case of emails and trade records. It was a case where the market's secret language was captured in real time. The Rajaratnam scandal becomes much darker when you realize it was not simply about one man trading on one stolen secret. It was about a whole ecosystem in which information itself became a commodity. In a fair market, people analyze public information and accept the risk that others can do the same. But in an insider trading scheme, time itself becomes the unfair advantage. If you know an earnings result, a merger discussion, or a boardroom development before the public does, even a few minutes can be worth millions. That is why this case felt so corrosive. It attacked the basic promise of the stock market, that while people may have different skill levels, the rules of access are supposed to be the same. Federal prosecutors said Rajaratnam profited from inside information he received from multiple sources. Public case summaries identify people connected to the scheme, including insiders at major companies and well-placed business contacts. The government argued that this was not casual rumor sharing. It was a pattern of trading on confidential, material, non-public information. And this is where the human drama gets powerful. Because insider trading cases often reveal something uncomfortable about elite business culture. Confidential information can begin to move through private circles in ways that feel normal to the people inside them. A tip over the phone. A small clue dropped in conversation. A quiet call after a meeting. In that world, the line between friendship, status, influence, and criminal conduct can start to blur, until a prosecutor redraws it in court. The public summaries of the Rajaratnam case describe illicit profits and avoided losses tied to the tips. They also make clear that the conspiracy involved more than one person and more than one company. That matters because it turns the scandal into something bigger than a personal moral failure. It becomes a story about a hidden marketplace operating alongside the public one, a whisper economy where information reached those who could monetize it first. And then there is the sound of that economy. The reason Rajaratnam's scandal still feels modern and cinematic is because investigators did not merely infer the conspiracy from trading patterns. They captured voices. As public case summaries note, law enforcement recorded thousands of wiretapped communications from phones connected to the case. That changes everything. Because once there are tapes, the story is no longer abstract. It becomes intimate. It becomes immediate. Viewers do not just hear about illegal information flows, they can imagine them breathing inside private conversations. This is why the Rajaratnam case became a defining insider trading scandal. It made Wall Street sound different, less like a temple of finance, more like a back room where confidential knowledge moved quickly, quietly, and profitably. And once the tapes existed, the collapse of the public image became almost inevitable. By the time the case reached trial, the question was no longer whether Galleon had an edge. The question was whether that edge had been built through a criminal conspiracy. The jury answered that question with unusual clarity. There is one reason the Raj Rajaratnam scandal never felt like a typical white-collar case. The government didn't just read documents, it listened. Wiretaps transformed the investigation. They gave prosecutors something white-collar defendants rarely expect law enforcement to have: live, recorded conversations that could help a jury imagine the hidden world behind the trades. Public summaries of the case describe 18,250 wiretapped communications involving 550 people, collected over 16 months from 10 different telephones, including home, office, and mobile lines. That number is staggering on its own, but the real impact is dramatic rather than numerical. Because when the public hears insider trading, many imagine spreadsheets, technical legal arguments, and silent financial engineering. Wiretaps changed that image completely. They made the scandal audible. They made it feel immediate and alive. They turned abstract finance into dialogue, urgency, secrecy, and risk. This was one of the reasons the case hit so hard culturally. It made Wall Street look less like a distant, respectable machine and more like a human network where people traded favors, confidences, and bits of non-public information the way other criminals trade contraband. The use of wiretaps also made the prosecution's case feel aggressive and historic. Rajaratnam was not just another executive facing an SEC complaint. He became the face of a new era in white-collar enforcement, one in which prosecutors showed they were willing to use tools traditionally associated with mob and drug investigations in financial cases. That shift sent fear through the business world, because if private calls could become courtroom evidence, then the old confidence that everyone does it and nobody can prove it no longer felt safe. The result was devastating for Rajaratnam. In May 2011, he was found guilty on all 14 counts. In October 2011, he was sentenced to 11 years in prison, fined $10 million, and ordered to forfeit $53.8 million. The U.S. Attorney's Office described the sentence as the longest prison term in history for insider trading at that time. That sentence was not just punishment, it was a statement. It told Wall Street that insider trading would no longer be treated as clever cheating by privileged people in expensive suits. It would be treated as a serious crime that could send a hedge fund billionaire to federal prison for more than a decade. And in scandals like this, that public message matters almost as much as the legal result. Because Rajaratnam's fall did not just destroy one man's empire, it punctured the myth that elite financial networks could always protect themselves through silence, status, and technical complexity. Once the tapes existed, the market's whisper economy had a soundtrack. And once that soundtrack played in court, the legend of Raj Rajaratnam was finished. The easiest way to tell this story is to say Raj Rajaratnam was rich, got greedy, got caught, and went to prison. But that version is too small. Because what made this scandal famous was not only the defendant, it was the message. At sentencing, the U.S. government emphasized that Rajaratnam's crimes struck at the fairness of the markets. The punishment, 11 years in prison, a $10 million fine, and $53.8 million in forfeiture, was meant to show that insider trading would be treated with real seriousness, not as a white-collar shortcut. That is why this case still matters. It was a public lesson in something many ordinary investors suspect, but rarely get to watch unfold so clearly. The market is not only shaped by intelligence and discipline, it can also be distorted by privileged access, secrecy, and personal networks operating just outside the line. For years, insider trading carried a strange cultural image. To some people, it almost looked glamorous, an expression of being in the know, of moving with the real currents underneath public markets. The Rajaratnam case stripped that glamour away. It showed insider trading not as sophistication, but as contamination. And it did something even more important. It changed fear. Before this case, many on Wall Street may have believed insider trading was difficult to prove unless someone turned witness or left a trail too obvious to ignore. After Rajaratnam, people had to confront a new reality. Phones could be tapped, conversations could be played, and private arrogance could become public evidence. That is the kind of shift that outlives one defendant. Rajaratnam's sentence also stood out because it was not symbolic in a light way. 11 years is long enough to tell every executive, trader, consultant, and corporate insider that privilege has limits, at least when prosecutors decide to push hard enough. At the same time, the scandal leaves behind an uncomfortable truth. One conviction does not erase the deeper problem. Insider trading scandals survive because markets are built around uneven access. The law draws a line, but human incentives keep pushing people toward it. As long as information equals money, there will always be people tempted to monetize what they are not supposed to know. That is why Raj Rajaratnam remains such a strong subject for scandal storytelling. His case contains everything: ambition, money, secrecy, betrayal, surveillance, and finally punishment. And unlike many financial scandals that end in settlement or ambiguity, this one ends with a clean legal judgment and a hard prison term. That clarity gives the story weight. It means the audience is not left asking whether the system ever responded. It did. The jury convicted. The judge sentenced. The government celebrated the outcome as a warning shot to the entire financial world. So the final line of the story is not just about one billionaire hedge fund founder losing everything. It is about a market being reminded that secrets are not supposed to be private currency. And when they are, eventually someone may be listening.